Everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Thursday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. On today's video, I wanted to talk about a loan product a little more complicated than a lot of programs, so I wanted to shoot a long video to capture some of the nuances of it. So this is called the All-in-One Home Program, and it's based out on a philosophy called Velocity Bank. That's how I was introduced to it about 6 years ago, where essentially you're replacing your mortgage, replacing your checking account, and replacing your credit card with one financial product. Essentially, the way this program works is it's a first lien home equity line of credit, or HELOC. And you can buy a property with this loan program, but you would need to put a good amount down. You really need 25% down. You can get a gift for up to 15% of that, but you have to be coming out of pocket with at least 10% to buy a home with this program as your first lien. Now, for people that already own a home and have an existing mortgage or own the home outright, but have a substantial amount of equity, this is a loan that you can tap into 75% of the home's value. So if you just bought a home and the home is worth $400,000 and you have a mortgage of $390,000, it's not really going to make a whole lot of sense. You could do it, but you would have to come out of pocket with something like $90,000 to $100,000 in order to make the numbers work. This is the important part. Again, you've got this home equity line of credit, and it's designed to act as your checking account. So when you get your payments from work, they go right into that account and pay down that loan. And it's also designed to be used as your credit card, where you're paying your expenses that you would normally pay on your credit card at a 22% interest rate with this home equity line of credit with much lower interest rate. And it's really important because when this was initially pitched to me, this idea, it was portrayed as this silver bullet, end all be all, and this is the savior for those that own their own home with a mortgage. And it's really not. It can be a great tool. Again, it's not going to be for everyone because you need a certain amount of equity for it to even work. But even if you can qualify, you have to have a really strict budget for it to make sense. So let me talk about kind of both ends of that, the pros, how to use this well, and how it could go badly. So if you use this well, if you're doing the way I described, your paychecks, or if you're self-employed, when you do get paid, it goes into that account, you're paying your expenses, you have a disciplined budget to where you have more money coming in than money going out, you can pay off your mortgage or your house, I should say, in much, much shorter time frame. And of course, it's all going to depend on how much money you have incoming versus coming out. But the really cool thing about home equity lines of credit in general is that the monthly payment is tied to the amount that you owe. It's not a fixed charge like with a mortgage where it stays the same until you pay it off completely. So it can be a really powerful tool if you are disciplined in that. However, if you're not, if you're putting more money on it, you'll have a limit. So there's only so high you can go on the loan. But if you just continue to kind of stay at that limit, it's going to have a much higher interest rate than your typical mortgage. And it's not a fixed rate. It is variable. It's going to be tied to what's going on in the market. So you can put yourself in a really bad spot if you're not disciplined with the money coming in versus the money going out for this loan. The other big thing is it does require a very high credit score. You got to be at least 720 credit to be able to qualify for this. But it can be a really great tool. And definitely would advise, if you have interest in this type of loan, reach out to me directly, or if you know another loan officer that offers this kind of thing, reach out to them and go through your exact situation. Because again, what it's all about ideally is paying off your loan faster. Now, if you own a home with a mortgage, let's be clear, you can pay it off much faster than the normal 30-year rate if you just make extra payments. It's the same concept. The big difference and the big advantage with this one is that your monthly payments will change, will lower based on the balance that you have versus staying the same with the mortgage. But again, I don't want to make it seem like this is the silver bullet or end all be all, but I do want to highlight it as a great option for those that use it correctly and can qualify, because not everyone will. So if you have any questions at all or have a situation you want to run through, shoot a comment below or feel free to call, text, or email me. But thanks for tuning in to this video, and I will see you next time.